Imagine you're in a coffee shop. A couple at the table next to you is talking about money, like people do. The woman says, "I've been waiting to refinance my mortgage. The Fed just cut rates. Should be good news, right?" The man nods. "Yeah, I heard it too. I'm waiting to move some money into a CD. The rate should get better." Both of them are waiting. Both of them feel like they're being patient and smart. They're waiting for the Fed to cut rates so they can make their move. Here's the thing. They're both making a mistake, and it's costing them real money. Not a little bit of money, a lot. And the worst part? They're not alone. Millions of people are waiting right now for rate cuts that they'll never actually feel. They're waiting for help that's already happened. Waiting for relief that went to someone else. Or waiting for changes that literally don't control what they think they control. Today we're going to talk about why waiting for the Federal Reserve is one of the most expensive forms of financial patience there is. And we're going to show you exactly why the cut you're waiting for isn't actually coming to you. It's going somewhere else entirely. Let's get into it. When the Fed cuts rates, there's a specific picture that plays out in most people's minds. The announcement comes down, the media reports it, and almost automatically, everyone assumes the same thing. Interest rates on credit cards go down, mortgage rates drop, savings account yields improve. Everything just gets cheaper. That's the story. That's what we've been told to expect. Here's what actually happened. In late 2024, the Federal Reserve cut rates by a full percentage point. A whole percentage point. That's a massive move. During that same period, the average credit card interest rate fell by only 0.23%. Do you see what happened there? The Fed cut by 1 percentage point. Credit card rates fell by less than a quarter of 1%. That's not a rounding error. That's math. And the math says banks kept 77% of the rate relief for themselves. A 2024 report from the Consumer Financial Protection Bureau looked at exactly this. They found that between 2020 and 2024, credit card rate spreads, the gap between what the Fed charges and what banks charge you, got bigger, not smaller. The Fed cut and cut and cut, and each time they did, banks took the opportunity to expand their margins. They pocketed the cuts instead of passing them along. The system isn't designed to flow cuts down to you. It's designed to flow them up to the banks. And here's the psychological part that really gets people. You see the Fed announcement on the news. You hear rate cut. Your brain immediately thinks, that's good for me, but your credit card bill doesn't change. Your mortgage stays the same. And you never really understand why the announcement that was supposed to help you didn't actually help. Here's something that will genuinely shock you. The thing you're waiting for might have already happened. When people talk about waiting for a rate cut, they picture the big announcement. The Fed makes the official decision. Everyone hears about it. Then, stuff changes. That's not how it works. Markets price in expected rate cuts weeks or even months before the Fed actually announces them. Your high-yield savings account, the rate it pays you is determined by what investors expect the Fed to do, not what the Fed has already done. So by the time you hear about a rate cut on the news, the people paying attention to the market have already moved their money. The best rates have already been locked in. The savings account you're about to open has already cut its rate because the market already knew the cut was coming. You're planning to move. The people paying attention are already unpacking boxes in a better place. And the mortgage rate situation is even more backwards. Your mortgage doesn't actually follow the Fed rate at all. It follows the 10-year Treasury yield. And that yield is driven by long-term inflation expectations, not the overnight rate the Fed controls. Here's where it gets really painful. Mortgage rates actually rose in early 2025, even though the Fed had cut rates 3 times in 2024. How is that possible? The 10-year Treasury yield was higher. The spread between the Treasury yield and mortgage rates widened. All of that happened independent of what the Fed did. So the person who was waiting to buy a house, waiting for the Fed to cut so mortgage rates would drop, they're waiting for the wrong number. The Fed doesn't control mortgages. The market does. And the market can do the opposite of what the Fed does. You could wait for years, and the thing you're waiting for might actually go in the opposite direction. Here's the part that's less talked about but more important. When the Fed cuts rates and asset prices go up because cheaper money means people buy more stocks, who benefits? The people who own stocks. And who owns most of the stocks? Rich people. The wealthiest 0.1% of households in America own over $23 trillion in financial assets. That's not income, that's assets. Money that's working for them 24/7. The bottom half of the population, about $10 trillion in total assets. Less than half. And here's what happened between 2020 and 2024. The top 0.1% saw their assets grow by 91%. The bottom half saw theirs grow by 46%. Rate cuts accelerate that gap. They don't close it. Asset prices go up. The people with the most assets benefit the most. The people with most of their money sitting in cash, young people, working class people, ordinary people, their money quietly loses value to inflation while they wait. The Fed cuts rates, the wealthy get richer. You get an announcement telling you it happened.
Here's something banks did that almost nobody noticed. When rates were high, less than 3/4 of people kept their money in interest-bearing accounts. Most money just sat in checking accounts earning nothing. That made sense when rates were low, but when rates got high, people started moving money into savings accounts that actually paid interest. So the percentage of deposits earning interest went from 71% up to 77%. More money in interest-bearing accounts. Sounds good, right? The banks are finally paying people to keep their money there? Not exactly. Here's the trick. Yes, more people are getting paid interest, but the interest rates they're getting paid are way lower than the rates were. Banks are paying more people less money. It's math that looks good on the surface, but works out great for the bank. They've expanded the group of people they're paying interest to, but they've also slashed the rates they're paying. The net effect? They're actually paying out less in total interest while serving more depositors. Now here's the part where I give you something you can use immediately. Something that doesn't require waiting for anything.
Research from LendingTree found something remarkable. When credit card holders called their banks and asked for a lower interest rate, 76% of them got one. Not 76% of rich people, not 76% of people with perfect credit, 76% of people who asked. The average rate reduction? 6 percentage points. That's not 1/4%. That's 6 full percentage points. On a credit card balance, that's real money. And here's the thing. If you didn't get that reduction, you could try again. Maybe you will next time. But how many people do you think actually make that phone call? Probably fewer than 24% of credit card holders. Because waiting for the Fed feels passive and smart. Calling the credit card company feels awkward and you might get rejected. But one phone call delivers more rate relief than anything the Fed has done for you in the past year. Let me repeat that. A single 5-minute phone call can deliver more help than Federal Reserve decisions that took months to happen. That's not complicated. That's not waiting for anything. That's just asking.
The former Fed chair, Jerome Powell, said something in a 2025 press conference that should be printed on every personal finance blog, but isn't. He said, "We don't set mortgage rates at the Fed. We set an overnight rate." Let that sink in. The Fed controls the rate that banks charge each other to borrow money overnight. That's it. Overnight loans between banks. Everything else, your mortgage, your car loan, your credit card, your savings account, all of those are downstream of that one overnight rate. They're influenced by it, but they're not determined by it. The entire cultural narrative of waiting for the Fed to cut is built on a misunderstanding of what the Fed actually controls. The Fed doesn't set your mortgage. It doesn't set your credit card rate. It influences them. It's one input in a much larger system. But people wait for Fed decisions like the Fed has direct power over their personal finances. It doesn't. This is the frame shift that changes everything. You're not waiting for the Fed. You're waiting for a chain of events that may or may not happen to you, filtered through bank decisions, market reactions, and timing that nobody can predict. Here's something that makes the waiting even worse. The entire premise of rates are going down, so I'll wait, is already collapsing. The Fed's own projections from June 2026 showed the federal funds rate at the end of the year rising to 3.8%, up from 3.4% in March. That's a reversal. That's the Fed signaling that more cuts aren't coming. In fact, investors are currently pricing in a 50 to 70% chance of at least one rate increase by the end of 2026. Think about what that means for the person waiting. They delayed refinancing their mortgage because they thought rates would drop. Now rates might go up. They delayed opening a CD because they thought yields would improve. They delayed opening a CD because they thought yields would improve. Now yields might get worse. They delayed moving money around because they were waiting for the Fed. Now they're waiting in the wrong direction. Here's what you actually need to understand. The Fed doesn't stop cutting because it wants to help you. And it doesn't cut because it cares about your credit card debt. The Fed is managing the economy. It's one institution with one hammer trying to hit multiple nails. Sometimes those nails are your mortgage. Sometimes there's something else entirely. And the institutional reality is that rate cuts take a long time to reach ordinary people. By the time they do, they're smaller than the Fed's action. Sometimes they go in the opposite direction entirely. And the people who benefit most are the people who already have assets. Waiting for the Fed is not patience. It's not a strategy. It's outsourcing your financial decision-making to an institution that doesn't know you exist and couldn't help you specifically if it tried. The decisions that matter for you. Can you call your credit card company and ask for a lower rate? Yes, right now, today. Can you refinance your mortgage today instead of waiting? That's up to you. Can you move money into a CD today with a current rate instead of waiting for a future rate? Absolutely. Can you shop around for a better savings account rate today? Of course. Those are decisions.
Those are things you control. Waiting for the Fed is hoping for an outcome you can't influence and probably won't feel.
The rate cut you're waiting for isn't coming to you. Either it already happened before the announcement, so you're too late, or it didn't reach your actual financial life, so it didn't matter. Or it went to the people who own stocks instead of the people who pay credit cards. That's not cynicism. That's how the system actually works. The psychological trap is that the Fed announcement feels like good news. It makes you feel like you can wait, like you're being smart by being patient. But patience that waits for someone else's decision is just indecision dressed up as strategy. The people who come out ahead aren't waiting. They're calling their credit card company. They're shopping for new CD rates. They're refinancing their mortgages regardless of whether the Fed cut or not. They're making moves based on what they control, not based on hoping for changes in things they don't. If this changed how you think about Fed announcements, I want to hear about it. Drop a comment below and tell me, are you waiting for something right now? A rate cut? A mortgage refinance? A better savings rate? Because that's the exact moment to stop waiting and start acting. And if you found this useful, the real breakdown of how these systems actually work, not the headlines, but the actual mechanics, make sure you're subscribed. This is what we do here. The things that matter explained simply. See you in the next one.